Hello, and welcome to our channel. Today, we are uncovering a story that has the potential to redefine the global economy as we know it. Canada, in a move that has caught many by surprise, has found a way to escape the relentless economic pressure imposed by U.S. tariffs by turning to a new, powerful trading partner, China. This isn't just business as usual. This shift is happening right now, at a critical juncture when the United States is engaged in a fierce trade war. This conflict isn't only with China, but extends to some of America's closest allies, including the European Union. Canada, Mexico, and the European Union are all increasingly pivoting their trade towards China, challenging the traditional dominance of the U.S. economy. This raises a seismic question. Are we witnessing the rise of a new economic superpower? And if so, what fate awaits America's global influence and economic strength? The implications are profound. The very fabric of international trade is shifting beneath our feet. Let's rewind and understand how we got here. The Trump administration unleashed a bold economic weapon, a 20% tariff slapped on a vast array of Chinese goods. The goal was clear: force China to alter its trade policies and level the playing field for American companies. But China refused to back down. Instead, it retaliated with equal ferocity, cutting back on its purchases from the U.S. and solidifying new, stronger trade agreements with Canada, Europe, and others. This backlash blindsided Washington. What was meant to be a quick tactical strike spiraled into a protracted conflict that now threatens American economic stability. The consequences are already severe. American farmers, factories, and energy producers, industries once buoyed by Chinese demand, are now caught in an economic crossfire. With Chinese purchases dwindling, demand for American goods has plummeted, prices have dropped dramatically, and uncertainty about the future haunts every boardroom and farmstead across the country. Meanwhile, companies from other nations are stepping in to fill the vacuum, capitalizing on America's retreat and seizing market share. Many people don't realize just how deeply entwined American businesses are with China. It's not only a matter of manufacturing goods cheaply, but also accessing millions of Chinese consumers eager to buy American products. If tariffs remain, prices on everything will rise, jobs will be lost, and some iconic American companies could face collapse. Consider tech giants like Apple, Intel, and Qualcomm. Apple relies on China not only for assembling a large portion of its iPhones, but also for selling nearly 16% of its total sales. Qualcomm generates nearly half of its revenue from the Chinese market. Losing access to China isn't just a market loss, it's a direct threat to their survival. The automotive sector paints a similarly dire picture. General Motors sells more vehicles in China than it does in the US, and Ford is already reporting significant financial losses tied to tariff tensions. Tariffs mean more than just higher import costs. They translate into lost customers and declining sales on a massive scale. Even globally recognized brands like Nike and Starbucks are heavily reliant on China. Nike earned $7 billion from China alone in the past year, a staggering sum that's now at risk. Tariffs were designed as a punitive measure against China, but their true victims are American businesses and consumers. When the U.S. imposes taxes on Chinese imports, companies face two grim options: absorb the added costs and erode profits, or pass those costs on to customers by raising prices. Either choice delivers a blow to the American economy. Steel and aluminum prices have skyrocketed, inflating the cost of building homes, cars, and infrastructure. Everyday goods, from trash cans to coffee makers, are now more expensive, squeezing household budgets everywhere. Some voices claim tariffs will bring manufacturing jobs back to the U.S., but the reality is far more complicated. U.S. labor costs are significantly higher, and decades of offshoring have gutted the domestic industrial base. Many factories have closed or relocated overseas, leaving the U.S. without the necessary infrastructure or machinery to quickly ramp up production again. The clothing industry is a prime example. Despite tariffs, producing garments in China remains far cheaper than rebuilding factories on American soil. This challenge extends to specialized sectors like airplane parts, which largely depend on global supply chains. The outcome? Companies face soaring costs, consumers pay more, and jobs vanish if businesses fail to adapt. If the goal is to strengthen American manufacturing, short-term tariffs won't suffice. What's needed are smarter, strategic, long-term policies that rebuild competitiveness without collateral damage to the economy. The world is watching. The future of America's economic power hangs in the balance. Will it rise to the challenge, or will the tides of global trade sweep it aside? China isn't backing down. Instead, it's striking back. Quietly, strategically, and with growing force. It's cutting back on imports from the U.S., forging new trade alliances with countries like Canada and the European Union, and shifting the global economic balance beneath America's feet. The impact is already shaking American industries to their core. Across the U.S. heartland, Farmers who once depended on China's massive appetite for soybeans, corn, wheat, and pork are now stuck with overflowing silos and crashing prices. Their crops rot. Their debts grow. Their hope fades. What once was a booming export economy is now a wasteland of overproduction, with the U.S. market share in China's soybean imports collapsing from 40% in 2016 to just 18% by 2024. Brazil and Argentina have swept in to claim the spoils, seizing 74% of the market, leaving American farmers gasping for air. Manufacturers are next. Machinery and tech goods once shipped by the ton are collecting dust. Energy giants, long reliant on China's demand for American oil and gas, are watching contracts vanish. China is buying less and looking elsewhere. Fast. While Washington plays defense, Beijing is moving with precision. Its diplomats are already in Europe, shaking hands, signing deals, and offering what the U.S. no longer can: stability. To leaders wearied by Trump-era trade aggression, China appears not as a threat but as a calm, calculated partner. And if Europe bites, the stakes shift dramatically. Trade between China and Europe could explode, leaving the United States on the outside, locked out of deals it once dominated. Back home, even retail giants are feeling the sting. Walmart, desperate to keep shelves stocked and prices low, turned Chinese suppliers to cut costs, but China pushed back. Hard. When Walmart asked for discounts, Beijing didn't budge. Instead, they summoned the company for a stern meeting. This wasn't just about prices, it was a warning. Corporate giants and governments are now in open confrontation, pulled into a geopolitical chess match with no clear rules. And beneath it all, the American economy trembles. Inflation appears deceptively calm, but the new tariffs are ticking time bombs, threatening a surge in consumer prices. The Federal Reserve is trapped: raise interest rates and choke the economy, or ease off and risk inflation running wild. Every move feels like stepping onto cracking ice. Meanwhile, the energy world is transforming. Canada, once America's top supplier, is pivoting east. With U.S. tariffs hitting Canadian oil, Ottawa refuses to flinch. Instead, it builds. The Trans Mountain Pipeline is being expanded, opening a direct route to Asia. And in British Columbia, the massive LNG terminal is nearly complete. Set to launch in 2025, it will deliver 14 million tons of liquefied natural gas annually, much of it destined for China. Canada is doing more than dreaming big, it's sealing deals. RC Resources has inked a long-term contract to supply 1.5 million tons of LNG every year to ExxonMobil's Asia-Pacific division, directly feeding China's hunger for energy. China isn't just diversifying, it's strategically uncoupling from the U.S., and each deal brings it closer to energy independence and global leverage. In a bold retaliatory move, Canada is even considering slashing oil exports to the U.S., threatening refineries already strained by supply disruptions. It's a sharp geopolitical pivot, and it's cutting deep. The U.S. is being slowly, methodically edged out of the world's critical energy markets. And the ripple effects only widen. Food processors, equipment manufacturers, freight companies, everyone connected to the U.S. agricultural chain is bleeding losses. The crisis has grown so severe that the federal government had to step in with an unprecedented $122 billion in aid, including $7.7 billion just to support soybean farmers. Meanwhile, European pork exports to China surged 35%, taking yet another bite out of U.S. market share. This isn't just a trade war, it's an economic realignment. China is moving fast, reshaping supply chains, sealing new deals, and rewriting the rules of global commerce. And with every move, it's isolating the United States, politically, economically, and strategically. What started as a bold plan to weaken China's economy has spectacularly backfired. Instead of buckling, Beijing has doubled down, forming deeper alliances, securing vital resources, and positioning itself as the future anchor of global trade. If the U.S. doesn't act, and soon, it risks being shut out entirely. Cut from vital supply chains, shut out of energy routes, abandoned by allies, forgotten at trade tables. The window for strategy is closing, and the next moves will determine who leads the world economy and who follows. This battle for dominance is no longer theoretical. It's here. It's escalating. And it's moving faster than anyone predicted. We'll be watching it all unfold, every twist, every consequence, every global ripple. Because this isn't just about policy. It's about the future of power itself. Stay tuned.